We're live, Simon.
Hey, everybody. Welcome to another episode of Simon Dixon Live. And today we are going to be discussing a very popular topic, which is on inflation, deflation, what comes next. And I wanted to do an emergency broadcast because like the previous IMF broadcast where I deconstructed an interview from the IMF managing director giving her speech, I want to do a similar thing because it was really popular, and I want to do the same thing for the recent Jerome Powell interview, who's the head of the Fed, on why they're not worried about inflation and whether you should be worried about inflation. So we're going to jump over to that interview in a second. I'm just going to play it and I'm going to stop and give some commentary and translate it into non-Federal Reserve talk. So we're going to be doing a bit of a screen share today. It's a fairly long interview, so I'm not sure if we're going to get to too many questions today. But if we do, we'll try and take a few questions at the end. But most of it's going to be content rich today, where we deconstruct the interview. So just before we head over there, please do like, please do share, please do subscribe. We've got a couple of hundred people already in the waiting list, so I think we got a lot of people live, and we're going to jump straight over to the interview now. So I'm just going to set up a screen share. And if this all works, then you'll be able to listen to the video with me. And I'm going to switch my camera off. Azad, is it looking good for the video?
Yeah, you need to maximize it.
Okay, so let's put this on max. And then we're going to play this video. And what I'm going to do is I'm going to stop and pause as and when I'd like to retranslate it for you. So hopefully you can all see the video still. And Azad will let me know if there's any issues. And I'm going to turn the volume up a bit. So
let me start the answer by saying that Congress has given us two goals: maximum employment and price stability. And we have tools to achieve those. We're strongly committed to achieving them. Before the pandemic hit, we were very close to those. Unemployment was at a 50-year low. Jobs were plentiful.
Yeah.
Yeah, this it's sort of breaking up. The sound is it's gone low, and then
yeah, this is the maximum sound on the Wall Street video website, Wall Street Journal.
No, it was fading out, so there's a slight technical glitch. If you want to rewind it back and start again.
Okay, well that bit's not too important anyway. We'll play.
Wages were moving up. And inflation was also running close to, but a bit below our 2% objective. That was a year ago now. Let's look at where we are today. The economy began to recover last May from the very sharp downturn at the beginning of the pandemic and made good progress through the beginning of the fall, let's say. And then progress slowed sharply overall with the winter COVID spike, which reduced job creation for the last 3 months through January to about 29,000 a month, which is a drop in the bucket for an economy our size.
Okay, so just before we jump in too deep, this whole premise of the interview is to dispel people's fears about inflation. And the reason for that is because obviously with the bond yield situation at the moment, the market is forecasting inflation. And so Jerome Powell from the Federal Reserve had to come on and give his update on why he thinks that we can poo-poo the threat of inflation. And so just before we jump into this and we go to the employment side, I want to make sure that we're all on the same page with inflation. And so when I think of inflation, I think of it split into two. The first is consumer price inflation, which is the cost of goods and things that we normally spend our money on in everyday living expenses. And the second is asset price inflation. And that's the price of real estate, the price of property, the price of the stocks, and various other financial assets, which are highly correlated to the actions of the Federal Reserve. Now, most people think of inflation as a monetary phenomenon, and which is true, but then you have to go one layer deeper, which is how money is created. And really, money is created at a private bank every time they issue a loan. So when I think about consumer price inflation, the CPI index is commonly known as, I'm thinking of it in terms of a function of the level of indebtedness, but not just the government debt. So what we're experiencing right now is the government going deeper and deeper into debt in order to make up some of the shortfall in expenditure, because consumers have stopped swiping out the credit cards, purchasing in the shops. And so therefore the economy grinds to a halt, especially during these lockdowns. And the level of indebtedness of the individual is not increasing at the moment because everyone's hoarding and trying to preserve their cash. And so when we're talking about consumer price inflation, to me, it's one layer deeper than just a lot of money printing. It's what's happening with the level of indebtedness. And so to me, in consumer price of inflation is a function of how much debt is being taken on. Now, the banks are not increasing people's indebtedness levels at the moment because they're trying to be conservative, knowing that they have the real estate market crash just around the corner. So they're trying to give as many of their toxic assets away to your pension and put as many of them on the Federal Reserve through quantitative easing schemes and trying to recapitalize rather than take on additional loans. So the reason we're not experiencing inflation, despite the fact that all economists and everyone, the Austrian economists, believe that we were heading to hyperinflation, is because consumer debt is not increasing. But what is increasing is government debt, which isn't directly leading to the inflation effect right now, and quantitative easing, which is where the central bank is printing up brand new digital money and using that to purchase bonds so that it can fund all of this government debt. And also that this money ends up making its way into asset price inflation. So asset price inflation is where money is being used in order to pump in financial markets because the Federal Reserve has decided that free market capitalism and market pricing is no longer important as we switch from free market capitalism over to different ways of organizing economies. So what we're seeing right now is the Federal Reserve coming out and saying we're not too concerned about inflation because they probably know that the level of consumer debt is not increasing, but they know that it's all being factored into making the rich richer and the poor poorer, because asset price inflation benefits those who have assets, and therefore it's causing the largest rich-poor divide that we've had in history. And this is causing a lot of people confusion about why all this money printing is happening, but yet we're not getting the inflation effect. So let's now turn back over to Jerome, where I think he goes into the employment conversation to answer the question.
So today, we're still a long way from our goals of maximum employment and inflation averaging 2% over time. More recently, as you point out, we've got rising vaccination, we've got cases at lower levels, we've got strong support from fiscal and monetary policy, and while there are still risks, there's good reason to expect job creation to pick up in coming months. And we need that because we're still 10 million jobs short of where we were. Fewer people are working than were working when the pandemic hit. So it's a lot of ground we have to cover. And
so Jerome is absolutely right here that the key to the economy turning around is job creation. And job creation is the goal of governments in order to try and get the economy back on track. But the Federal Reserve is doing nothing to stimulate job creation. That's where it's the fiscal responsibility of the Treasury and government. What the Federal Reserve is doing is they're stimulating the asset price inflation rather than job creation. So while he talks about that being the primary goal, what seems to be the primary goal is not letting the stock markets crash and not letting the real estate markets crash, because they know that will reveal the weaknesses in the banking sector, which will trigger off a domino effect where FDIC insurance can't cover it, and you have a 2008 style too big to fail banking effect, just like we saw in 2008 that they patched up by taking on all those toxic assets. This is what they're really trying to prevent, which is why the rich are getting richer and the poor are getting poorer in the current stimulus packages.
And those people are mostly in areas that are directly affected by the pandemic. That's service industries, public-facing jobs. I'll also mention inflation, since that's the other side of our mandate. We seek inflation that averages 2% over time, and we want that to happen because we want it to average 2% over time. We want inflation expectations to be anchored at 2%, and that's really the goal.
So let me retranslate that for you. When the Federal Reserve says that they want the inflation to be 2%, what they're saying is that they want your savings to be decreased at 2% every year, so that you can speculate on stocks and housing and real estate instead of holding cash. So what they want you to do, because we are operating off the world's largest debt-based regulated Ponzi scheme called the dollar requires you to disencourage savings. They don't want you to save, because the rules of the dollar and the rules of fiat currency are that if you want more money, you have to have more debt, because they've outsourced money creation to the private banking sector. And yet, if you want less debt, because everyone's burdened, you have to have less money, which leads to a recession, stroke depression. And they don't want that to happen, so they try and stimulate it instead. And so they try and launch a hidden tax, which is what they're saying. So when someone says inflation, what they're saying is they want the value of your savings to be decreased, so that when you have large amounts of debt, the value of the debt that you have to repay goes down over time. So always remember, when you're hearing this, the rules of debt-based fiat currency: if you want more money, you have to have more debt. If you want less debt, you have to have less money. And so that's what the way to interpret inflation when the figureheads are talking about it on TV.
So right now, inflation is running below 2%, and it's done so since the pandemic arrived. We do expect that as the economy reopens and fully picks up, we'll see inflation move up through base effects, which means just that the very low readings of March and April will fall out of the 12-month window, and also through a surge, if you will, in spending that may come as the economy fully reopens, and that could create some upward pressure on prices. The real question is how large those effects will be, and whether they will be sustained or more transitory. And I'll just say that for several decades, the U.S. and the world economy have been in low inflation world, and low inflation is what people expect both here and around the world. For those expectations to change, businesses and people would need to believe that larger increases in prices would be repeated year after year. And we think it's unlikely that these deeply ingrained low inflation expectations would suddenly change. It is more likely that effects like the ones I described would be one-time effects, as the one-time effects of the fiscal booth fade. We have the tools to assure that longer-run inflation expectations are well anchored at 2%, not materially above or below, and we'll use those tools to achieve that end. So that's my thinking on the economy.
And so those tools that he's referring to are what we talked about earlier, which is quantitative easing in order to not allow the markets to crash, and increasing and stimulating the levels of indebtedness in an economy that's plagued by too much debt, because we can't have a correction in asset prices, because that would then be a reversal of the 0% interest rate environment that created the rich-poor divide that we're experiencing at the moment.
So I'll get to inflation in a second. Unemployment. You know, when people are vaccinated, when they're able to go travel and feel comfortable seeing their family again, there could be a big pickup in activity. Does that mean employment could get back to where it was before the pandemic sooner than you previously thought?
Well, the answer is I would hope so. So let me tell you how we define maximum employment. People focus on the unemployment rate, but it's really much broader than that, because if you haven't looked for a job in the last 4 weeks, then you're not counted as unemployed. You're counted as out of the labor force. So if you look at those who have left the labor force since the pandemic, and also those who are unemployed, then you get a very large number of people who are around the edges of the labor market. And it should be thought of as generally people who want to go back to work. It will take some time to get back to maximum employment. It took us many years to get there before, and that'll really just depend on how strongly the economy picks up once we do get past the pandemic, and once economic activity picks up and hiring picks up. Again, there's a lot of ground to cover to get back to what I would call maximum employment. We want to see wages moving up. We'd want to see that the gains in employment are broad-based, and that different demographic groups were experiencing it. So we have a high standard for identifying what maximum employment is, and we think it'll take some time to get there. But that is exactly the state we're trying to achieve, and we're trying to achieve it, as quickly as we possibly can.
Okay, so the important thing here is that he's saying that the goal is employment, but we don't see that. What we see is, again, the tools that they're using is they no longer have interest rates. Interest rates are traditionally the way, if they cut the interest rates, it will cause the costs of everybody's mortgage and debts to enter into a depression if they increase it. So that would be the traditional way you do it. But they do have QE, quantitative easing, which is leading to the wealth inequality and the price of assets increasing. But remember, the next tools that they do have is issuing their central bank digital currency, which won't be backed by debt, would be my forecast, as a mechanism to deleverage the economy as their only and last tool. So when they are always being vague about they've got tools that they can use, they're saying that the traditional monetary tools are no longer working, and we need to look at new tools, which I think is a central bank digital currency. And by deleveraging the economy, then for fiscal policy, the government can charge much, much higher tax, and then they have that large fiscal stimulus. With regards to the employment, you got to remember that many of the service sector businesses are never actually returning. Manufacturing is still moving to the economies with the cheapest costs, that being China, and most businesses are investing in technology. So what's happened as a result of this pandemic is that businesses are looking at how they can invest in technology to replace people's jobs with robots. And that's a trend that's causing the counter trend to the inflation. These investments in technology is driving more and more things converging towards free. So if you read my book, Bank to the Future, Protect Your Future Before Governments Go Bust, I talked about the free economy is going to be taking more and more jobs. So hiring will only pick up again in a debt-based fiat Ponzi scheme if you start maxing out your credit cards again. So what they're saying here is we need to figure out how you can start maxing out your credit cards so that people can start employing again. They don't want you to save. They don't want you to be, implementing sound personal finance. They want the jobs back, and the way they're going to do that is by stimulating debt, and that's the only thing they're looking to stimulate, and their tools that they're looking to push.
So just because we hit 4% unemployment, for example, if labor force participation was still low relative to where it was last February, does that mean we're not at maximum employment?
Yes, I mean, we'll look overall at a range of indicators, and certainly the unemployment rate and the labor force participation rate are two key ones. It's actually even broader than that, but certainly labor force, we've had the sharpest drop in labor force participation in many decades coming out of the pandemic. And that just means that there are quite a few people who are technically out of the labor force, but were working in February. So some of them will have retired, but the vast bulk of them actually want to go back to work, but they're not currently looking because perhaps the business where they worked is still temporarily closed or permanently closed. So the answer is yes. 4% would be a nice unemployment rate to get to, but it'll take more than that to get to maximum employment.
And do you think we could get there this year?
No, I think that's highly unlikely. I think we have significant ground to cover. If you think about it, if you add back in a broader measure of unemployment is about 10 million people, I'm hopeful that we can begin to make good progress again, that hiring will pick up. So as I mentioned, hiring was strong during much of last year after the pandemic, after the critical phase of the pandemic in March and April. but it really slowed down over the winter with a spike in COVID cases, and it hasn't. We don't think it's really picked up much yet. We're looking for that to happen as cases come down, as vaccinations increase. Hasn't happened yet, so I think it's not at all likely it would reach maximum employment this year. I think it's going to take some time to get there.
Let's talk about inflation for a second. Between the $900 billion that Congress approved around Christmas and then this $1.9 trillion package Congress is looking at right now, that's some serious spending. And the market has been pushing up longer term interest rates, maybe because it seems to anticipate an unwelcome increase in inflation. Is the market wrong?
So just before he answers that, I want to have a word on the market. This is the wrong question for Wall Street Journal to be asking Jerome Powell. Jerome Powell and the Federal Reserve, they no longer believe in the markets. They killed free markets by pushing a policy of 0% interest rates rather than using market rates and quantitative easing to ensure markets won't crash when the Federal Reserve essentially ends up guaranteeing the price of all assets in a movement towards modern monetary theory. So asking the Federal Reserve about markets, the Federal Reserve gave up on markets a long time ago when they pushed this experiment of how they can drown the markets with money to push up the prices and really move towards all assets ending up on the Federal Reserve balance sheet during the next financial crisis event. So I think asking the Fed about markets is a bit of a silly question because they don't believe in markets anymore.
Well, is the market wrong? That's a pretty broad question, I would say. Maybe to be a little more specific, let me talk about the sort of market pricing, I think is what you're really asking about. So in terms of the bond market. So you're right, bond market rates moved up. And as far as that is concerned, a number of factors are factored into it. But from our perspective, we monitor a broad range of financial conditions, and we think that we're a long way from our goals. We think it's important that financial conditions support the achievement of those goals. And I would be concerned by disorderly conditions in markets or a persistent tightening in financial conditions that threatens the achievement of our goals. I would be concerned if those things were to happen. In terms of the other question tends to be markets reflect an estimate of when we would raise interest rates. And so let me talk about that. That's the other question. So the question is, what would it take for us to want to raise interest rates? Right now, our policy rate is effectively at zero.
So before he gives, Jerome gives his answer, let me tell you exactly what they're going to do in order to raise interest. Firstly, there is no way to raise interest rates at all without crashing the economy into one of the worst depressions we've ever seen. The game of raising interest rates is 100% over, and there's no option to do that at this stage. Interest rates, remember, the rules of money. If you want to have more money, you have to have more debt. If you want to have less debt, then you have to have less money. That's the rules of the debt-based Ponzi scheme. So you have to find someone else to go into debt in order to keep the regulated Ponzi scheme alive. Interest rates discourage debt and encourage savings. They don't want you to save. You can't save. If you start saving, you screw up the whole economy. So interest rates going up is just completely not an option. They want that down. They don't want you to save. They want you to go deeper into debt. The only way to raise interest rates is to reform the monetary system altogether and remove banks' ability to create money and replace it with non-debt-based central bank digital currency, as I talked about over a decade ago in the book Bank to the Future, Protect Your Future Before Governments Go Bust. Now, that is how you deleverage and you move to a more sustainable way of creating money, but there's consequences to that. And that is the effect that it has on your personal liberties, on your freedoms, because at least when banks are creating digital currency, as they do right now, although it has a leveraging effect and it's a Ponzi scheme, at least the government is one step removed from your money. when you drive more to the sustainable model of deleveraging and having the central bank or the government issue currency direct without the debt-based Ponzi scheme in the middle, you have all the consequences of how that power will be abused, which is really the next big debate. So in order to have some of the conditions, well, let's see what he answers, and then we'll cover a bit more on the conditions to raise interest rates.
So we have a new framework, and we're strongly committed to implementing that framework, and we have guidance out to implement that framework. As I mentioned, with rising vaccination and other things happening, fiscal policy support, there's good reason to think that the outlook is becoming positive at the margin. And in coming months, we could see spending and job creation picking up. So let me talk about the guidance. And by the way, the guidance is always, it's outcome-based. It's not date-based. So we never say, hey, we're going to do this in 18 months or 24 months. It's always when these conditions are fulfilled. So for asset purchases, as you're aware, we say that they'll continue at least at the current level until we achieve substantial further progress toward our goals. That's actual progress, not forecast progress. And as I mentioned, there's good reason to think we'll begin to make more progress soon. But even if that happens, as now seems likely, it will take some time to achieve substantial further progress. For interest rates, to raise interest rates above zero, very simply, we want to see labor market conditions consistent with our assessment of maximum employment, and that means all of the things that we talked about. We'd want to see inflation sustainably at 2%. We want to be on track to have inflation run moderately above 2%. So these are highly desirable outcomes that would represent an economy that's very far along the road to recovery. And there's just a lot of ground to cover before we get to that. The last thing I'll say is this, and I want to be clear about this. If we do see, as I mentioned, if we do see what we believe is likely a transitory increase in inflation, where longer-term inflation expectations are broadly stable at levels consistent with our framework and goals, I expect that we will be patient.
Okay, so let me retranslate that for you. Here are the conditions to raise interest rates that the Federal Reserve will be looking for. Firstly, they will only raise them when enough people have stopped saving and started taking on more debt. That is the condition. As long as people are saving, and as long as people are looking after their own personal finance, and as long as people are hoarding, they will not raise interest rates. They need you to stop saving, and they need you to take on more debt, then they can consider it. If people can go back to consuming beyond their means, then it may cause some kind of inflation, because inflation is a debt phenomenon from my model of how I think about it. And if the new money created by you taking on lots more debt, and businesses taking on a lot more debt, and governments taking on a lot more debt, if that surpasses the trend towards technology making more and more things free, then you might start to get an inflation effect. And this is why so many people are expecting inflation, but they haven't started to see it, because we're not getting that increase in the debt level, and we're seeing asset price inflation with all the QE. But people are hoarding and people are trying to save because they don't have any choice at the moment. And the technological innovation is also driving less and less employment, more and more things to become cheaper and free. If we get inflation, they will raise the rates only under one condition. And that is to try and control some of that inflation if they can get more and more people into debt through this low interest rate environment. And then they will take the very same people that saved the economy, i.e. they were looking for you to take on debt to save the economy, then they'll put those interest rates up and send you bankrupt. So if anyone's got those mortgages, flexible mortgages right now, they're looking to put those rates up once you save the economy, if you get through this situation. And then they want to put your rates up so you can no longer afford your mortgage, so they can cool down the economy and punish the people that saved the economy by taking on the debt in the first place. That's how the rules of the business cycle work. And so they want, they will only put interest rates when enough people go deeper and deeper into debt to inflate markets. And that's how they'll try and control inflation, by punishing those that took on the debt to save the economy in the first place.
So there's a lot there. Thank you for that. I guess, the question is has the recent run up in bond yields been consistent with your economic outlook and with the new framework that you've adopted that takes a more relaxed approach to inflation?
I don't want to be the judge of a particular level of one interest rate among many, one asset price, if you will, among any. Our new for your the people at your conference benefit, our new framework says that we will seek inflation that runs moderately above 2% for some time after we've had a shortfall of inflation. And it also says it commits us to not raise interest rates just because the labor market gets strong. And those things, I think, will be good for the labor market over time. Again, I would just say, as it relates to the bond market, I'd be concerned by disorderly conditions in markets or by a persistent tightening in financial conditions broadly that threatens the achievement of our goals.
And I understand why you wouldn't want to comment on a specific level of rates, even if the level of rates isn't a problem. Was the speed with which real rates adjusted over the last week problematic in your view?
It was something that was notable and caught my attention. But again, it's a broad range of financial.
So remember, Jerome doesn't believe in markets anymore. He believes that the Federal Reserve is bigger than the markets, and we don't need free markets. We don't need market pricing. So he's not so concerned about the market's perception of inflation through these bond yield increases. He's more in belief that we're switching to the next phase of monetary policy where markets don't matter anymore.
Financial conditions that we're looking at, and that's really the key. It's many things, and we want to see, and would be concerned if we didn't see disorderly conditions, orderly conditions in markets, and we don't want to see a persistent tightening in broader financial conditions. That's really the test. It's not appropriate to isolate one particular interest rate or price. It's more of a broader assessment that we make.
I guess what I'm wondering is, the market now believes the Fed will raise rates earlier and faster than it thought a week ago. Are you saying that's consistent with your outcome-based policy guidance and with your new framework?
So have you noticed that the new model for determining how pensioners allocate, or pension fund managers allocate your pension, is not based upon fundamentals, not based upon the economy, but based upon the belief about what the Federal Reserve will do next? So we really have moved to a completely different environment in terms of how investors analyze. So markets don't matter, fundamentals don't matter, economics doesn't matter. It's really about what the Fed does next, which really is, to me, an indication that we've switched from free market capitalism over to fiscal stimulus, which is the model of the more socialist type environment. And that's going to lead to tax rate increases and drive us more and more towards the Federal Reserve owning all assets in a big rich-poor divide, 100% tax, and really a completely new model that's coming over the decades ahead as a result of this Great Depression of the 2020s, should they choose not to reform the banking and monetary system.
It's going to depend entirely on the path of the economy. So I laid out the conditions.
You mean the path of the Federal Reserve, not the economy?
In which we would consider raising interest rates, and that's labor market conditions that are consistent with maximum employment, which is, that's a big thing to get to, and it will take some time to get there, right? Inflation sustainably at 2% and inflation on track to run moderately above 2% for some time. So those are the conditions. When they arrive, we will consider raising interest rates. We're not intending to raise interest rates until we see those conditions fulfilled. And so that it's really the timing will depend entirely on the fulfillment of those conditions. And as I said again, if I've told you that we think we're likely to see inflation move up during the course of this year through really two things. First, the base effects I mentioned, but also just kind of reopening effects where businesses will be potentially hit by a lot of demand as the economy, but you could see bottlenecks, you could see prices moving up. We're inclined to see those as transient. And there's a difference between a one-time surge in prices and ongoing inflation. Ongoing inflation, where prices go up year after year after year, tends to happen when people's psychology becomes that they believe that's what will happen, and they have no faith that the central bank, frankly, will prevent that from happening. So, as I've said, the key thing is to keep longer run inflation expectations anchored at 2%. If that happens, then a transient increase in inflation will not affect inflation over a longer period. And we intend to use our tools to keep inflation expectations anchored at 2%, which gives us the ability to do all of the things we do when the economy is weak.
It could take months, though, for the data to contradict or validate this narrative about transient inflation. And obviously, investors are twitchy right now. Do you think your guidance is too vague right now to be properly understood by investors?
I'm trying to make it as clear as possible. And I went through, the guidance. I think the guidance for the tapering asset purchases has an element of judgment in it. But I've also said that we will, well in advance of any decision to consider tapering asset purchases, we'll communicate about our sense of progress towards substantial further toward the goals, substantial further progress toward our goals. So we're not looking to surprise people with that. And as far as the rate liftoff guidance, it's pretty specific. And as I said, it will take some time to get there. If you think about it, you've got to have a very strong labor market and inflation performing in line with it's a picture of an economy that is all but fully recovered. The sooner that happens, the better. But I would say realistically, that's going to take some time.
And as we sit here today, do you think the hope of a brighter outlook you've discussed here might lead to substantial further progress being achieved this year?
Again, I've been so far been able to not reduce it to an estimate of time. I mean, that will come, I think, when we can see that. Right now, we haven't been making much progress. I mentioned 29,000 jobs per month for the months of November, December, and January. So, and spending was maybe a little better than that, but in the job market, you saw a real slowdown at job creation. That wouldn't get you to maximum employment anytime soon. That's just not enough. So, I do expect, and many forecasters expect, that there'll be a pickup in job creation. We'll have to assess that when it comes. I don't want to be making. But again, I think realistically, though, it's March, and we're going to start. Presumably, in the next couple of months, we'll start to see stronger employment, and we're going to want to see substantial further progress in both maximum employment and stable prices. That's going to take some time. It just will take some time because you've had 3 months now where you didn't make much progress. So we've got to get going and start making it again. And for us to assess that and signal forward, it's going to take some time.
As you noted, the Fed is buying $120 billion per month in Treasury and mortgage securities. You've been saying for the past year that your asset purchases are designed to support market functioning. Have you seen anything in the Treasury market that suggests a need to lengthen the maturity profile of your purchases?
Okay, so here we get to the crux of the tools that they are using. So a bit of education here on how the banking system works. When people default on their debts, and the biggest mechanism for creating the dollar is through real estate markets. So if you're investing in real estate, it's a bet upon the banking system continuing to create money in order to prop up the real estate markets. So the reason that real estate is unaffordable for most people that just want to simply live in it rather than speculate is because it's the favorite tool that the banks use in order to create new digital currency every time they issue a loan. Now, the rules are that when banks create money, when they issue a loan, it creates new digital currency. But when people default on their debts, when people default on their mortgages and real estate, money actually disappears. And it's when money disappears, which is the real thing that ends up with bail-ins, bailouts, and all of the extreme measures that we saw in 2008, when it exposes the too big to fail banks for what they actually are. And so the key here is when they started talking about the assets that they're purchasing, there was a heavy tendency towards government so that they can actually do these fiscal stimuluses, and also real estate through mortgage-backed assets, which were the same assets that have been moved gradually over to your pension and to the Federal Reserve balance sheet in this massive accumulation. So as we said, whenever if anyone defaults on their mortgage, then money disappears, and that's what will trigger the Great Depression. So when I first started talking about where the Great Depression of the 2020s was come from, all those years back, is when we get the defaults on real estate and mortgages, so that they can then accumulate these assets so they can keep the world's largest regulated Ponzi scheme called the dollar alive, and by ensuring that dollars do not disappear if people default on their mortgages. So because this would send the banking system essentially into bankruptcy, and your pension is dependent upon many of these assets as well, and the markets being propped up in what the Federal Reserve has tried to be doing over the last few decades in the experiment of increasing debt, lowering interest rates in order to create a wealth effect so that everyone feels wealthier through their real estate and stock market and pension schemes. In the end, all of this debt, in order to keep the system alive, has to be passed on to the government, which is where I get my forecast that only a central bank digital currency of non-debt-based money is the way to keep this alive at the end of a debt cycle. Mortgage-backed security purchases that they were talking about, remember, that's code word for bank bailouts. Mortgage-backed securities, when they're purchasing, they're trying to keep banks alive because they know that the insurance compensation schemes for your bank accounts don't cover a systemic risk in all the too big to fail banks going bust or having financial uncertainty in one go. So it is also a pension crisis bailout hidden by jargon, as they are paid by taxes and inflation. So you're paying them twice, through your taxes and through, if we get this eventual inflation effect, then that will be the way that this is actually paid for, so that they can achieve their goals in the future. So I think we're going to just do a bit more of the interview, and then we'll head over to some questions if we have some time.
So we think our current policy stance is appropriate. Mentioned the federal funds rate is at the effective lower bound, which is our technical name for zero or close to zero. We provided really strong guidance about the conditions we need to see before we considered raising it. We're buying $120 billion in treasuries and mortgage-backed securities across the curve, and we'll continue at least at that pace until we see substantial progress toward our goals. Financial conditions are highly accommodative, and that's appropriate given the ground that the economy has to cover. It's always the case that if conditions do change materially, the committee is prepared to use the tools that it has to foster achievement of its goals.
Well, and if there were some kind of rate move that you felt represented a threat to your outlook, what would you do to address it?
Well, that's a sort of hypothetical situation. You know, we would use our tools. It's hard to say in the abstract, but we would use our tools as appropriate to foster achievement of our goals.
There's been some discussion in recent days. It's gotten a lot of attention. The idea of selling bills or letting bills run off of your portfolio to address a collateral squeeze in money markets. Is that something you think needs to be considered at this time?
Nick, you know, as I said, I wouldn't want to speculate. Really, I'll just say we'll if conditions do change materially, we'll be prepared to use our tools in whatever way is appropriate at time to foster the achievement of our goals.
I know a lot of this talk about inflation and interest rates can feel abstract. And so I wonder if you could put into plain language what the practical effect is of the changes the Fed has been making over the last year to your framework. What does it mean for everyday workers?
Great question. So I guess I have to say, for a long time, and when I was entering the job market years ago, when we had high inflation. So when the job market got good and tight, and employers were, actively seeking people, and there were plenty of jobs, inflation would be moving up, and therefore the central bank, the Fed, would be raising interest rates to cool off the economy. And I would say 50 years ago that was appropriate because there was this tight connection between unemployment and inflation. More recently, though, I think the Fed established its credibility several decades ago on inflation, and since that time, the connection between having a lot of people out of work and inflation under control has gotten very, very weak. So our new framework very explicitly takes that takes that in, that new learning, that new understanding. It says that we won't raise the interest rates to cool down the economy just because unemployment gets lower, just because employment gets high. We're going to wait to see signs of actual inflation or the appearance of other risks that could threaten achievement of our goals. And we've seen that the economy can sustain very low levels of unemployment without inflation. So what does that mean for job seekers? It should mean that the job market will be stronger over time. We also saw the.
Right, I think we're going to call it there. I think we got enough of that. But in a sense, the main takeaways here is that the Fed doesn't believe that inflation is going to be a problem because they know that they've got lots of tools that they're moving towards because of their disbelief about markets anymore. What this essentially means is that when we have high debt, we have high inflation, which is what they were talking about before, an environment where technology is not making goods cheaper and not making things free, then we have a few effects that we need to explore. So when people start saving, then the government will go deep into debt as well, because they need debt in order to stimulate the market. And then they need to prop up markets for the wealthy, which is the QE. They won't stop until everybody is deeper and deeper into debt and stops savings. And that's what we're going to be seeing next. And so it's moving all over towards the fiscal stimulus, which is where, in the case of America, the 1.9 trillion stimulus, this is a movement towards socialism and to ensure that money goes to small businesses and less to the wealthy, which is a benefit because QE just goes straight to asset price inflation. And so really by doing it through the government's balance sheet, you get the opposite of that as well. But this is an irreversible trend. And the next tools is what we need to concern ourselves with, which is the privacy and the removal of human rights and liberties that come as a result of these algorithmic artificial intelligence, central bank digital currencies, and excessive government control as we move to modern monetary theory as the new tools and the new mechanisms. And so with that, I'm going to switch away from the screen share, push the camera on, and okay. Awesome. Okay, so we managed to do that with only about 10 minutes left, but why don't we take a few questions, Azad, in the final 10 minutes that we got. Hope everybody enjoyed that emergency broadcast, trying to translate what is very complicated for many people into understanding how it fits in with the realities of where we are today. So Azad, I know that we've got a Slido board, and we emailed out the Slido board. And on the Slido board, if you use your phone, we've got a few questions here. You can upvote other people's questions, and we'll take a few questions, and we'll go into rapid fire mode. I'll try and answer as many questions as I can and keep them as short as possible. So Azad, what have we got on the Slido?
The first question from Anonymous. Hi, Simon. If you have Bitcoin, not a lot, but life-changing money in dollar value, how does a person cash out to make his or her life better without selling Bitcoin?
So cashing out, again, watch the video that I created last week, or the last video on the 3 questions you should ask. Really, so the cashing out means that you're going to have to buy something. What I'm guessing, reading between the lines here, is that you are mixing your spending money with your investment funds. And I encourage everybody to spend less than they earn, invest the difference, implement a strategy like I taught in retirementplanb.com in the free video series, and not mix your spending money so that you don't have to sell your Bitcoin. Because if you're selling Bitcoin, you're going to have to buy something else. And that was really turning to the 3 questions that we covered in previous videos. Also, what was the second part of the question? Okay.
How does a person cash out to make his or her life better without selling Bitcoin?
One way to do that, and what people are doing at the moment, and you should really think about whether this is right for you or not, is that a new emerging trend is collateralizing your Bitcoin, whereby you lock up some of your Bitcoin so you don't have to sell it, and you can take out a stable coin loan in order to meet some of your more stable expenditures. So that's become a very popular mechanism for keeping your Bitcoin without having to sell them, using some of these collateralized lending products.
Okay, next question is from Graham. Do you think we will see a less significant sell-off percentage-wise during the next bear cycle? I want to hodl through, but worried about an 80 to 90% drop.
So again, I think that this is a common misperception about what you want in Bitcoin. So having been around for the this last decade, the bear markets are the best part of Bitcoin if you're thinking long term. Now, I understand psychologically, if you're not used to these bear markets, they can really be soul destroying. But if you're not a trader and you're dollar cost averaging in, then if markets just go up, then that's really bad for averaging in. But if markets crash, then you get to accumulate more Bitcoin while everybody else is fearful. And so getting an 80 to 90% correction is something that could happen, can happen, has happened. I don't fully expect it to happen this time around because of the greater understanding of how many people are trying to accumulate Bitcoin, but that can also trigger off many of the institutions that might have to rebalance their portfolios as a result of some of these corrections and risk management. But crashes are good for accumulation. And so if you're averaging in, then you want markets to correct so that you can accumulate more Bitcoin for your long term, if you're thinking long term. If you're thinking about trading in short term, then you might be very fearful of those.
Okay, next question is from TJ. What will happen to fixed term debt like loans during very high inflation? Will it be inflated away? Surely the banks will not allow this.
So if we have inflation, then the level of indebtedness is exactly those trends. The banks have really no control over whether they do that. It's the Federal Reserve that can determine the rate of the loans, and that's what will determine that. But so many people are in debt situations that people would be quite excited by the prospect of the value of their debt decreasing relative to their purchasing power.
Okay, a question from Alexander. What happens to Bitcoin when the dust has settled after the bubble has popped and several major countries have implemented modern monetary theory, electronic fiat ban on crypto?
So I don't believe that there will be a global ban on Bitcoin. The reason for that is because governments need the next tax grab. A market that goes beyond $1 trillion with a bunch of people that may, because of uncertainty, not have declared on their tax returns means that the governments get a massive opportunity to grab some of those taxes. So what I think is more likely to happen is subpoenaing the exchanges for the data so that they can try and charge as much tax on it as possible. and go for regulations of financial institutions rather than outright bans. We've seen this again, flip-flopping with India in and out of it's banned, it's not banned, it's banned, it's not banned, it's banned, it's not banned, it's banned, it's not banned. And they've come out again, the latest one is not banned. So there is no trend. It's a trend of the mind. There's been no signal around seeing this global ban of Bitcoin. The reason is because when there's a wealth effect and institutions are in and all the different types of players are in, you're better off going for regulations of the institution so you can grab the tax rather than removing that tax grab that governments need. So that's, I think, a much more likely outcome.
Okay, we've got Elaine from Fiji. Is this a good time to sell a house, or should we be holding assets rather than fiat in inflation if inflation is pending?
I can't give you financial advice or investment advice because it completely depends on your personal situation. But the answer to that question is not markets, it's politics. The answer to that question is 100% politics. And that's why in the Retirement Plan B 3-part video series, I talked about being prepared for inflation, deflation, another Ponzi scheme growth, and economic decline and depression, and how to protect your portfolio accordingly. Because the value of your real estate is not based upon supply and demand of markets, it's based upon the central bank's policy and where they move things next. So they could quite easily continue to try and inflate a bubble to keep the value up, or they could reach the end of a debt cycle and but it's 100% politics, not markets.
Okay, a question from Angela from New Zealand. In a zero interest rate world, banks are at risk of capital flight as people transfer to crypto for yield as well as capital gain. How will banks fight back?
Well, just because there's 0% interest rate, it doesn't mean that banks don't do that. So, they pass on the benefit to that. In fact, quite the opposite. Banks don't really want your deposit. They don't need your deposit. They have the license and ability to create digital currency every time they issue a loan. And so they only have to hold some of that as a token in order to meet regulatory environments. And then they loophole it through the investment bank anyway to not meet any of those reserve requirements and then hold them in assets rather than cash and everything. And so the way that banks will compete with the crypto industry is they will join the crypto industry. And we're already starting to see that with more and more banks starting to offer financial products based upon the crypto industry so that you get this seamless intersection between banking and crypto. And that's what we're seeing as a trend, really. So I don't think it really affects anything. They will just reach a stage. If you can't beat them, join them. And that's what we're seeing more and more by banks and financial institutions at the moment, seeing a lot of mergers and acquisitions, other financial products, and all sorts of stuff.
Question from Steve, who's in France. Or maybe Steve France, that's the surname. The Bank of France has said that Ripple XRP could be used as a base for European central bank currency. What do you think about this XRP and its effects on Bitcoin?
The reason I'm a shareholder in Ripple Labs, the company, and I don't own any XRP is because I don't really see the full utility of XRP, but the company holds a lot of XRP. So if people continue to buy into that perception that is needed, then it increases the value of the equity as well. So I believe that Ripple's technology to try and compete with Swift is an interesting thing. And if they can shoehorn XRP, the cryptocurrency, into that, then they can try. But really, it doesn't make much sense because with the cryptocurrency, it's about the cryptocurrency with the most liquidity that makes sense there. So if you can go in and out of fiat very quickly, then it's all about liquidity rather than anything else. And so really, Bitcoin's got the highest level of liquidity, Tether's got more liquidity, and Ethereum's got more liquidity. They might end up, what we've seen, using a lot of the technology that's not really dependent upon the cryptocurrency. So it's kind of a cryptocurrency play, but really I don't see the need for the XRP part of that.
Okay, room for one more question, Simon?
Yeah, we can do a few more because the broadcast went on quite long.
All right. Next question from Mark, who's from Edinburgh. What's your opinion of the Great Reset? Is this a move from the free market to communism?
Yes, it's a gradual movement, maybe not as extreme as communism, but you get the idea that we're moving over to governments owning everything, things becoming free, and money being reformed. And that is certainly the Great Reset spells out an artificial-led, technology-led economy, and that really fits in with the movement towards central bank digital currencies that we're moving towards. So certainly that is not quite a movement towards communism, but a movement towards the end of free markets and the belief that that markets prevail.
Next question from Sybil. What role will China play in the world economy? Most of America's imports are Chinese. Is the world reserve currency leaving the dollar?
I think the new world reserve currency will be a basket of currencies issued by a large global institution. So I think we'll get global central bank digital currencies. IMF wants to do that. And I think it will be backed by a basket of currencies. China's role in the future is that China is, from my perspective, they've been empire building. They're the next superpower economy. And at some stage, we will get a transition from the United States empire to the Chinese empire. I think that's inevitable, predictable, and guaranteed. And at least with China, they're not pretending to operate their internal economies based upon free market capitalism. They integrated free market capitalism, but they held many of the communist ideals in organizing their internal economy, which is exactly where America and the rest of the world is going with these policies and where everything is headed. So the way that I look at it is China's starting to look more and more like the United States every day. They've made a lot of the right technical moves, and the United States is looking more and more like China every day. And we're going to merge upon a socialist ideal that really China paved the way for the model. There's no doubt about that, and everything that is still being manufactured. These countries are not really picking up their manufacturing base.
Next question from Anonymous. The central bank will let banks fail this time. This is your hypothesis. However, the bank industry is huge and extremely powerful, more than the central bank. Comment.
So it may not play out exactly as it wants. So instead of that, what they could do is they could try to rehypothecate the world's largest regulated Ponzi scheme, which would mean that they would need to do bail-ins, bailouts, and they could use the central bank digital currency in order to prop up the banking system as well, rather than in these too big to fail systemic risk events. So there are a set of scenarios in which they could do that. My forecast is that they will actually instead let some of those banks go bust. The reason for that is social unrest. I just don't think the public will put up with the rioting in the streets that will happen as a result of people feeling that they've been so shafted by the economy and feeling such a drastic wealth inequality and wealth rich poor divide, at the same time as allowing the government to use a big chunk of that money to bail out the banks. I just don't think that the appetite for that to happen will be available this time around. We'll see. Let's do two more questions, Azad.
Okay, next question is from Rob. Is it the right time to take loan to finish project, townhouse 6 units? I am halfway. So far, no loan involved. I could finish 1 year later with my money only.
Really not a real estate developer myself, not really got too much opinion on that question.
Okay, James from Manchester. Is COVID 20% the increase in the price of goods this year? Will it sort out the debt overhang?
No, the debt overhang is irreversible. There's no way of fixing it. The only way to do that is radical monetary reform and radical banking reform. And so that's going to be the last question. I hope you enjoyed this, and we'll try and do more like this, where we pick apart some of the common speeches, try and retranslate it into the understanding that everyone can get to grips with in what can be very complex subjects as well. So if you enjoyed this broadcast, do me a favor, please do like, please do share. We are starting the number of people that are watching these live broadcasts is really, really increasing. So we really appreciate that. But I also believe that with some of the trends coming up, there's plenty more people that would need this content. So please do, if you enjoyed this, head over to Simon Dixon on YouTube. If you're watching it on social, hit the subscribe button, hit the bell symbol, hit all, and retweet and share that so that more and more people can get that, and YouTube can show us some more love, and we'll try and get as many views we did for the last emergency broadcast on the IMF. And so always remember, you are alive at one of the most interesting and exciting times in financial history. I'll do my best to keep you on the right side of that change. So always remember that. And it is that exciting time. We want to keep you on the right side of that change. Peace.